Welcome to our Financial Insights series, where we unravel the mysteries of personal finance. Today's topic is a crucial one. What is a credit card interest rate? Imagine using a credit card as borrowing money from the card issuer, which isn't free. That's where the interest rate comes in. The interest rate, commonly referred to as the annual percentage rate or APR, is the cost you pay for borrowing that money. Let's say your credit card has an APR of 18%. This means, annually, you're charged 18% on any balance you don't pay off each month. It's important to note that if you pay your entire balance by the due date each month, you generally won't incur any interest charges. For example, if you spend $500 in a month and repay it fully by the due date, you pay no interest. However, if you carry a balance from one month to the next, the interest rate is applied to the amount you owe. Suppose you only pay $300 of that $500 bill. Interest is charged on the remaining $200. Different types of transactions on your credit card, such as purchases, cash advances, or balance transfers, may have different annual percentage rates, APRs. This distinction is important because each transaction type affects your balance and the interest accrued in unique ways. Regular purchases typically have a standard APR, the rate often advertised when you first acquire the card. However, cash advances usually come with a higher APR, meaning the cost of borrowing cash through your card is generally more expensive than regular purchases. For example, if your card's purchase APR is 18%, the APR for cash advances might be 25% or even higher. Balance transfers, which involve moving debt from one card to another, often have their own APRs, sometimes featuring promotional rates. These promotional rates can be initially lower, such as a 0% APR for the first 12 months, but may increase significantly after the promotional period ends. Therefore, understanding the different APRs for these transactions is crucial for managing your credit card effectively and avoiding unexpected costs. By being mindful of these varying APRs, you can make informed decisions on how to use your card for purchases, cash advances, or balance transfers. The reason your credit card's interest rate is important is straightforward. A higher rate leads to greater costs over time, particularly when you carry a balance. Using the earlier example, if you have a balance of $200 at an APR of 18%, this will accrue interest each month. If this $200 balance remains unpaid, the interest accumulates based on the 18% APR, increasing the total amount you owe. Let's break it down. 18% APR means an annual interest rate of 18%, but credit card interest is typically compounded monthly. So, the monthly interest rate is 1.5%, 18% divided by 12 months. Therefore, for a $200 balance, the interest for 1 month would be $3, 1.5% of $200. If this balance is carried over to the next month, the new balance becomes $203 before any new purchases. Each month this balance is not paid off. The interest is recalculated on the new balance, leading to compound interest. This compounding effect means the longer the balance is carried, the more interest you will pay over time. Hence, understanding and managing your credit card's APR is crucial to prevent escalating debt due to compounded interest on unpaid balances. To understand how much interest you're being charged, you can calculate it using your APR and your average daily balance. Divide your APR by 12 to find the monthly rate, and then multiply that by your average daily balance for the billing cycle. In the case of the $200 balance at 18% APR, you divide 18% by 12, resulting in a 1.5% monthly rate, and then multiply this by $200 to find your monthly interest charge. Being aware of your credit card interest rate is more than just understanding a number, it's about making smart financial decisions. It's about knowing that if you spend $1,000 and only make the minimum payment of, say, $25, the remainder of your balance is subject to that interest rate, which can add up over time. It influences how you spend and pay off your credit card, affecting your overall financial health. Consistently carrying a balance can lead to accumulating debt that becomes increasingly difficult to pay off. Remember, a well-informed credit card user is someone who can effectively manage their finances and avoid unnecessary debt. Understanding interest rates helps in making decisions about how much to charge and how much to pay off each month. Stay savvy with your credit card, and you'll navigate the world of personal finance with confidence and ease. Thank you for joining us today, and keep an eye out for more insights into making the most of your financial journey.